2019, the most significant event actually was 5 words, and that was patient with further rate increases. The next thing would be the yield curve inversion, and last would be the escalation, breakdown, and then progress in the trade wars. Those 5 words that the Fed said in January were actually critical because that was a signal that they were done increasing interest rates, and they actually were now in a pause, and later on actually went into a mid-cycle easing. And then when you get into the July easing that happened, they actually said we're going to continue to support economic growth. So a complete flip from where we were in 2018. Coming into 2019, we were at 2.5% for Fed funds. We thought we were going to have 3 increases. Instead, we had 3 decreases and exit 2019 at 1 3/4 on Fed funds. It's not often that you get to buy 3-month bonds at a higher rate than a 10-year bond. And that really happened when the Fed said those 5 words. Investors rushed to lock in rates before the Fed brought rates down. So you have the 3-month bond that's responding to the Fed not having lowered interest rates yet. And then you have investors rushing to buy up longer dated bonds, driving their yields down. And suddenly we had the very rare and often unsettling occurrence of a yield curve inversion. Why is that significant? Well, it's only happened 4 times since 1983, and it's also historically, going back even further, been a really good indicator of a recession sometime in the next 6 to 18 months. And we think that that's something that we need to be concerned about. The trade war really impacts the manufacturing sector. When you look at the supply chain disruptions and the market access challenges that they have, and then throw on top of that the higher costs that are associated with that they cannot pass on, and then we get Twitter diplomacy and arbitrary tariff increases, needless to say, companies are a little bit hesitant to do a lot of planning, and they're getting somewhat conservative. If you look at the manufacturing surveys, they hit actually contraction levels in August, shortly after the trade talks broke off. GM went off strike, and we've had some progress on the trade tariffs, and so that started to improve, but quite frankly, the surveys are still very weak, and they're not much stronger since then. When you look at the beginning of 2020 versus the beginning of 2019, we have a Fed that's eased and is currently on hold, probably through the election, versus they were increasing. We have a trade agreement that's in place, the USMCA, and we have progress with a phase 1 deal reached with China, so trade has improved. The government shutdown has been averted, and we have a spending bill in place. And then you also look at inflation is tame, the markets are solid with an upward sloping yield curve, credit spreads are tight. We think that right now where we stand, that the markets are in good shape. Certainly we're concerned about the escalating geopolitical tensions, but we're also concerned about the trillions in par value that is currently trading at negative interest rates overseas in Europe. The 2020 election will happen in November. Typically, a U.S. president gets elected when the economy is doing well, but this president's been impeached, and he's going to have a trial, so that increases the uncertainty of whether we'll have regime change or not. When you look at the yield curve too, it did invert, and sometime between 6 and 18 months is a potential recession. We have a great piece up on the internet that Dave Hart and Sarah Conwell put together. I encourage you to read it. The Bloomberg economic consensus is for 1.8% growth. That's before the Boeing 737 MAX shutdown. That could be almost a 1% hit in the first quarter. So we may have our 12th year of economic growth, but it may feel very recession-like. We think rates will be range-bound for the year. Bonds are typically a safe haven asset, and so therefore, in times of uncertainty, typically bonds are places where people want to put money. Plus, when you look at it with all the negative interest rates, there's still a surging overseas demand for any positive interest rates. We think tax-free bonds are also going to be solid. There's fewer deductions, higher tax rates, This is one of the few places where you can actually have a tax-free investment and get some income. In this moderate growth environment that we have, this has been very helpful to corporate structures and corporate credit. With the low interest rates, there's still a lot of demand for additional yield. So we think that this is going to be another good year for corporate bonds and credit spreads. We have published a 2020 review and other helpful materials. It's on the link below. From everyone here at Ross Sinclaire to everyone, Happy New Year and all the best in 2020.